How do businesses finance operations and expansion? You're using tomorrow's money to pay yesterday's bills. That may be why you're running out of cash. You see net income on paper on that P&L, but you look at the bank and it's not there. What happened? By the way, just so you know, I'm not a licensed financial advisor. I'm an educator, and so make sure anything that I talk about here, you always run through the lens of a licensed financial advisor. By the end of this video, you're going to know how to subdivide bank accounts and fund your operations, all without borrowing money. We've had the privilege of working with hundreds of business owners over the last decade, and there are a lot of things that we've learned. When I got started in this business, I kind of knew what I was doing, but now after years of repetition, years of going through things, having thousands of hours of coaching, not only for myself, but also our team of coaches, I've realized that, wow, there's a lot that we've learned and there's a lot of trends that we've seen. And here's one of the myths and the trends that we've seen. We'll hear business owners either say vocally or just sort of intend, and they'll say this: hey, as long as there's money in my bank account, I must be making money, right? And we're like, no, that's not how that goes. We've also seen a lot of people sort of succumb themselves to the Peter Pan strategy of financial management, and they'll rob Peter to pay Paul. And we come back and we look, no, the IRS actually calls that stealing. So we don't want to do that either. And so we need to be in a position where we stop using tomorrow's money to pay yesterday's bills. I want to tell you a story that's, this one caught me off guard. So I was about 5-6 years in to working and advising and coaching business owners just like you. And I was talking with a group. They were actually a home building company out in the western part of the United States, and pretty sizable home building company. They had about $15 million in annual revenue. Not one of the bigger ones, but enough to where they had a lot of money coming in and out of that business. And we sat down and we started subdividing their bank accounts and setting up their dashboards as we do with everybody. And when we got to setting up their dashboards, they said, hey, is there a line item on here that we can track unfunded client deposits? Crickets start going in my head. I'm like, what's an unfunded client deposit? And they were like, well, you know how we take client deposits? I'm like, yeah, I got that. People take 10% client deposit on a project. And then they go, but we use that for other things. And I went, whoa. You kind of hear the tires screeching. I back up and go, wait. You take a customer's money for their project and then you use that money for something that is not related to that customer. I just want to make sure I'm hearing that right. They're like, yeah, but everybody does it. Everybody jumps off the bridge, right? We're not going to do that. That is not a healthy concept for running a business. And so I dug in a little bit more and I said, hey, just how much unfunded client deposits are we talking about here? And so we started digging and doing some math. $1.7 million of money that they had received in client deposits, and they had currently deployed in other areas that were not for those client projects. And when they got to that client project, what they were doing was using the next deposit to get that project started. Now, in the financial world, they call that a Ponzi scheme. And we've got to be super careful around that. And unfortunately, too many business owners either find themselves in a formal Ponzi scheme, meaning they know what they're doing, or an informal Ponzi scheme where this is the best they know how to do and they just hope the music doesn't stop. The truth is, too many owners have no idea where the money goes. They just know as long as there's something in the bank, then I must be in good shape. One of the things we don't know about money and don't really teach a whole lot, but this would be a great thing for you to teach around the dinner table with your kids, is money actually has its own behavior. So I'll write this out and we'll come back to our diagram. The first thing I want you to understand about money behavior is sort of the in-out paradigm, all right? Money that comes in is always less than $1. So if we get $1 right here, if that money comes in, do we keep that whole dollar? No. Down here, if we have $1 that goes out, meaning we're paying somebody something, do we pay that dollar? No, we pay more than that dollar. So $1 in is always less than $1. $1 out is always more than $1. What do I mean by that? So if I went to lunch and got a sandwich, and the sandwich on the menu board said $9.95, am I paying $9.95 for that sandwich? No. I'm paying $9.95 plus tax plus some fee for that person to turn the screen around and say, this screen's going to ask you some questions. It's the tip that I'm not quite sure I'm paying at the Order Up sandwich shop, but that's another issue for another time. So $1 out is always more than $1. But then $1 that you receive in as a receivable, do you get to keep that whole dollar? No. No, you've got cost of goods, you've got bills to pay, you've got overhead, you've got reinvestment back into the business. There's a variety of different things here that you've got to do with that. And so $1 out is always more, and $1 in is always less. In other words, $1 is never $1. That's the behavior of money that we've got to pay attention to. And I would even make this argument that for many business owners, whatever business you're in is actually not the business you're in. The business you're in is as an accounting manager giving and receiving cash, and you just happen to be offering a product to go with it. There are some industries that have a 70, 80, and 90% cost of good line item in their budget. What does that mean? That means 70, 80, 90 cents of every dollar that comes in just goes right back out to another vendor or supplier. So they're really more accounting firms than they are whatever product that they're generating. The other behavior side of money that I want us to pay attention is this idea of past, present, and future. So when we think about money, we have to look at it in these three phases. This is where sometimes the accounting world can really screw us up as business owners, because many times accountants are focused on the past in balance sheets and P&Ls. What do I mean by that? Well, the balance sheet numbers and the P&L numbers, although they kind of show real time, they're stamped pages that were printed in the past. And I can make the argument that if you took your profit and loss statement and circled the net income number on the bottom line of that profit and loss statement and took it to your bank and slid it across the table, you think they're going to give you that amount of money to withdraw? No, that's not real money. That's what I'm saying. It's in the past. But then we have money in the present. You know what that is? Cash in the bank account. So any money, any cash that's in the bank account, that is present money that you can see on a cash basis. So that's what you have to be able to spend. And then you've got future. What does that mean? That's looking at things like budgets, pro formas, calculators to think, what could we spend down the road if we ran through this calculation to be able to look at that? So money, a dollar's not a dollar. Dollar out's always more, dollar in's always less. And we've got to look at money in past, present, and future as it relates to our business. But too many of us take our eyes off this ball and we just look at the bank account of whatever's in there. That's what we're going to roll with. So Scott, I hear you. And like the frustration's boiling in me because I get this. I'm not looking at my money this way. I just think all money's my money. And how do I do something different? Don't worry. I've got a metaphor that I think is going to walk you through. And by the way, this is what we do. We're here to help you. I don't want you to feel that overwhelmed. If you need our help, reach out. We've got resources for you to be able to do it. So let me walk you through a metaphor that I think is super helpful. I want you to think about your one bank account like a popcorn bucket. So this is, imagine this is movie theater popcorn. I love movie theater popcorn. I could take my head and just dip it in a bucket of movie theater popcorn. You don't need to know all that, but you get my point. So when I go to a movie and I go get the biggest bucket of popcorn that I could possibly get, I do it every single time. And then I'm the guy that goes, hey, before you fill up the bucket, can you put some butter in the first layer and then the second layer and then the third layer? And they roll their eyes and they're like, yeah. And they put some of that delicious real butter. I know it's not real, but you get my point. So I get my bucket of popcorn. When I have a full bucket of popcorn, how much of that bucket am I going to eat? All of it. Why? Because I love movie theater popcorn. And it's all in one bucket. So in my mind, I can eat all that bucket of popcorn. But if I took that big, large, honking bucket of popcorn and I subdivided it into smaller buckets of popcorn, and let's say that there were 6 smaller buckets, am I going to eat all 6 of those buckets? No, you're going to make fun of me. Because you're going to tell me, Scott, you just ate 6 buckets of popcorn. I'm going to be like, well, they're smaller buckets. It's the same amount that was in the big bucket. But it doesn't matter. The reality is, money is a psychological game. If we dump it all into one big bucket, what happens if we spill a little bit of popcorn out of here? We're not going to pick it up. We're just going to leave it, right? I got a bunch of popcorn in there. But what happens if I spill a little bit of popcorn out of here? I'm picking that popcorn up because I don't have a lot of popcorn in that bucket. And so what happens is when we take all this popcorn that's in here, we think all that popcorn is ours, and it's not. Some of that popcorn goes to cost of goods. Some of that popcorn goes to overhead and payroll and rent and internet and all that. Some of that popcorn goes to the government so you don't go to jail, right? And so what we want to do, instead of putting all of our money in one bucket, we want to start subdividing that money into different buckets. So we want to do the profit bucket because I want to make sure my business is profitable. I'm not here to run a nonprofit. I'm here to run a for-profit. We're going to take it and put it in the tax bucket to make sure we don't go to jail. Put it in the operational expense bucket. Put it in the capital expense bucket. And then also put it in the cost of goods bucket to make sure all my vendors and all that. So I want to reinvest back in the business. I want to pay for overhead. I want to be able to not go to jail. I want to make some money on the back end. And I want to pay my vendors and suppliers. Now you can have other stuff in here that you put. We actually recommend businesses get started with 6 bank accounts, subdivided, actual bank accounts, not on a spreadsheet. Remember, this is a psychological game. It's not a spreadsheet game. It will not work on a spreadsheet. Well, I'm a CPA, and you may want to go to another channel. This is not for you. This is for business owners who really want to see this, okay? So how do we do this tactically? What we do is we go to our bank, and we say, hey, bank, I want to set up 6 bank accounts. The first bank account I want to set up is the all-income bank account, all right? The all-income bank account. There's a lot of guys talking about this, profit first, etc. These are all really, really good, but we just have to do them. The second we want to set up is a cost of goods account. So whatever our percent cost of goods is on the profit and loss statement, let's say it's 30%, then we're going to take any money that comes in here, 30% goes in there. That's a checking account. We start paying all of our vendors, subs, and materials out of that one account. So what happens if that account runs dry? The business is now talking to you saying you didn't account enough for your cost of goods, right? Now you know what you can afford and what you can't afford. Then we come over here and put operating expense account, capital expense account, then you can go tax account, and then we also come over here and do the profit account. All right? So let's say $1 comes in up here, and it's a receivable for $500 or $5,000 or $50,000 or $500,000. That receivable comes in. Whatever your cost of goods is, that's seen on your P&L, just move it over here, right there, right out of the gate. So if it's 30%, move 30% of that amount. If it's 80%, move 80% of that amount. And then whatever is left over is your new 100% that you're going to come down and you're going to move into each one of these buckets by percentage. So each one of these has its own defined percentage. And once you mark that percentage, again, we've got calculators that'll help you set this whole thing up. Super easy. We've got all these templates built. You just bring us the information. We can plug it all in and get your bank account set up. And so now when a receivable comes in, X percent goes here to cost of goods. The remaining percent goes out here, and now you run your business. So what happens if you run out of money in each one of these things? The business is now talking to you. So rather than you living out of one bank account thinking all this money is yours, it is not. This money is yours. That's it. But when we're up here, we don't know how much of that is in there. Well, Scott, I can just do that on a spreadsheet. Again, I want to reiterate, you will not. So how do you operate finance business operations and not have to go in debt? Well, there's a number of ways we can do it. Number one, the number one reason people get into debt is because they run out of cash for operating expense. So what this does is shut that opportunity off, number one. Number two, what we can do is continue to add more accounts. You're like, oh my gosh, 7, 8? Hey, lest you think you're anywhere close, our record holder for bank accounts with the client is 53. They got multi-locations, all that kind of stuff. But when we get to 6, 7, 8, in our little business, we have 11. So don't think it's not a big deal. Well, what about the bookkeeper? What about, there's 4 barriers you're going to have to get over, all right? Barrier number 1 is you. Well, I don't think we can do it. It's too much work. You just got to get over it. Aren't you tired of having to live on lines of credit and all this other stuff to finance expansion and business operation? Number 2 is your wonderful, awesome, sweet bookkeeper. Oh, there's so many more transactions. I just don't know what to do. He or she is right. 1 transaction per quarter, 1 transaction per quarter, about 1 transaction per month, and then normal. Really nothing changes, bookkeeper. It's okay. The third is the bank. The barrier you're going to have to get over. You're going to go, hey, I want to open these accounts. And they're going to go, no problem, we're going to charge you fees. Here's the strategy. Fire the bank. Go to another bank. There's hundreds that would love to have your deposits. And then fourth is the lumbering, all-powerful, all-knowing CPA. All right, now, if you're a CPA, just let's have some fun, all right? But let's also be honest. You've kind of driven people crazy in the past with this whole past look at cash and not looking at a modern look on cash. I know accrual accounting, you love it, and you want to like hang out with accrual accounting and like make out with accrual accounting in your station wagon under the overpass. That's just a little joke. You can put your joke in the comments to me if you want. That's fine. But what I want you to do instead is I want you to help your clients look at this through a lens of cash, because that's how they live their life. You do your accrual stuff. We call it accrual accounting, by the way. But you keep doing your accrual stuff. You keep doing all that. You need to check the boxes for taxes and everything else, but help your clients live in cash. And so when we bypass our own mindset, the bookkeeper, the bank, and the CPA, now it gives us freedom and flexibility. Remember this, all these people are here to serve you. You didn't hire them so you could serve them. You hired them so that they could serve the vision that you're trying to accomplish with this. So you need partners that will help you subdivide, get it out of one bucket and into these other buckets. All right, so I've shown this psychology and how we've broken this down. There's 2 other little things that I think would be helpful for you. One is if you could just have a spreadsheet that tracks your cash balance once a week. That's it. Put the weeks of the year across the top. Put the number of bank accounts you have down the left-hand side, the horizontal side in that column. And then every week for about 3 minutes, go to myonlinebank.com, look at all your bank accounts that you've got spelled out. And I literally would name them: OPEX, CAPEX, tax, profit, all income, cost of goods. That's what you should name your accounts. Put that on that spreadsheet, and then just whatever your bank account balance says on Monday, just snapshot. Well, can I pull that? There's no other tool that allows you to watch account balance after account balance after account balance every week. Here's what happens if you'll start doing this. Your cash balance will start to naturally increase. Why? It's because when you have everything in one bucket, that bucket has holes and it leaks out the holes. But when you have smaller buckets, you feel the leak. When something drops out, you pick it back up and you know what to spend. So how do businesses finance operations and how do they grow without taking on a lot of debt? They know where their cash, they know the behavior of cash, they look at it past, present, and future. They subdivide their cash into multiple bank accounts. They get these partners to work with them and not against them. And now what they have is radical clarity. And you just have to do it with repetition, predictability, and meaning. But none of this makes any difference if you don't know where you're going in your business, if you don't have a vision. So here's what I want you to do. Once you're done with this one, reach out to us if you need help, and also go down in the description link below. I've got a link to a video where I will walk you through the 7 steps of creating your strategic plan and your vision story. So click on that, do the hard work. You can work on the cash side of it, and you can work on the vision side of it as well. Listen, we are desperate to help you. We want you to win. We want you to grow. We don't want you to take on debt and have clarity. My name's Scott Beebe. We work with business owners between 3 and 100 employees to help them build their operating system for their business so that you can be liberated from chaos to make time for what matters most.